It's been a rough start to 2022 for stocks as a whole, but there's one sector that is off to one of its best starts ever. Hello once again, I'm Scott Inman. This week on the Fastest Four, what's being called the Great Equity Rotation. As we record this segment, the S&P 500 is down about 1% since New Year's Day. The NASDAQ is down more than 3%. But bank stocks, as measured by the KBW Bank Index, we're up more than 10% in the first week of 2022. That's the best start to a new year in more than a decade. According to data from Bloomberg, more than a third of all new cash flowing into U.S. ETFs in the first week of the year has gone into financial stocks. To put a number on it, that's about $3.8 billion. So what's going on? Well, analysts say the biggest reason is the Federal Reserve. The Fed meeting minutes were released last week and further confirmed what big investors were already thinking: rate hikes are coming. What the minutes also suggested was that those hikes may happen sooner or even at a faster pace than previously anticipated. That has analysts making new predictions. Goldman Sachs Group now expects policymakers to raise rates 4 times this year. U.S. Treasury yields rose 0.25% last week, and remember, rising yields drive bond prices lower. The Bloomberg Aggregate Bond Index was down 1.5% last week, and long Treasury securities lost over 4% for the week, which would have been the 6th worst entire year on record for the index. If the Fed raises the federal funds rate, interest rates that banks charge for loans go higher too, theoretically making banks more profitable. The questions moving forward, though, are how long does this equity rotation last, and do higher rates cause a drag on stocks overall? Well, that may not be answered for a while, but technology stocks have been rebounding this week some, and we could get a glimpse of how long the rotation lasts in the upcoming weeks as earnings season starts again. This is the time you may remember that corporations report how they are doing, and major banks began doing that this week. If banks show strong balance sheets, they could continue to be seen as a value for investors. As for the second question, higher rates are usually a good thing for stocks overall. According to a chart from LPL Research, historically, during periods where the 10-year Treasury yield rose at least 1%, the S&P 500 index was positive 11 out of 14 times. That's nearly 79% of the time, and stocks have been higher the past 7 consecutive times of higher rates. You have to go back to 1983 to find the last time the index was negative. The average return is 17.3%. Something to keep in mind during this increased time of market volatility in the new year. Thanks for watching.